Alright, so my man wants to look at Starbucks. Let's check out Starbucks to get it started. Let me erase some. Let me get rid of some of these other levels I have in Starbucks.
Yeah, I got a whole bunch of levels for Starbucks, man.
Yeah. I like to clean up my chart. I got the permanent levels I like to keep on there, but then I got just the levels for trading.
You know, I seen other things. I seen everybody rebounding, but NVIDIA struggling, man.
NVIDIA struggling where? They had like 104, 105, right? SMH?
No, before market, I think they closed at like 101, 102.
Nah, they have like 104.75 right now.
Right now?
Yeah. So I think everybody's waiting for them. They're not gonna go. They're not gonna go up crazy before earnings. I think people are gonna wait for earnings to see what's happening with them on the 20th.
This week, right?
No, earnings is near the end of the month, like the 28th, I believe. Yeah, so we gotta wait a little minute. They're gonna play that ping pong game in the meantime. Actually, need this camera. So I'm looking at the chart a lot, so I'll make sure I'm looking at y'all. Alright, so Starbucks, we're gonna go out to the monthly chart on them real quick. Let's see. We have heavy support around, like they caught support heavy at 73.13. So you're gonna label that monthly support. You know you can label your levels on TradingView, right?
What you said I can what?
You can label your levels, like put text on your levels.
Okay.
So you know what that line stands for. So sometimes people may forget their color codes. Like I remember my color codes pretty well, but with the important levels that I don't want to erase, I'm about to start putting text on those, like my monthly support level. But the text is definitely helpful. I'm gonna start using the text and the little symbols a little bit more on my levels. Alright, so we got monthly support at 73.13. And as we push up, we already pushed through that first resistance. I had 75.77 as an important level. When it broke above that, that was the time to catch it. Let me see. If we get back below that level, that's now going to be put entry. So I'm going to turn that to, I'm going to change that to a put entry level. This level right here. Let me get rid of that. Alright, so for calls, if you want to try to jump in some calls, it actually just hit a entry level at 77.70. That's a monthly call entry for Starbucks right there, 77.70. So we're gonna put that on there. Alright. Now we'll say take profit or areas where you could look at dollar cost averaging in, because you're looking for a long position or a short position?
A short position.
A short position. Alright, so something less than like 30 days?
Right.
Okay, so then for you, if you're looking for that, then your take profit, oh wow, 81, almost $81 exact. Yeah. You got $81 could be your initial take profit. And then we're going to say the next take profit level, we're going to put the next top of this wick over here at 83.49. Yeah, so 83.49 would be like top. but 81 is your initial take profit level for sure. And if you want an area where, well, nah, if you want an area where you could look to dollar cost average into your position, if we close above it, I see another monthly level back here. It wicked out down here back in March of 2022. It gave us a low around $78.99, pretty much $79. So you could jump in $77.60 dollar cost average into the position. I would say at like 79, and then get out by like 81. That seems like the move for Starbucks right there. Now your stop loss when you get in, if you get in at 77.60 and we have a pullback, because you're going to get a contract that expires a couple weeks out, I would say you will make your stop loss that 75.70 level. So 75, if we get below like 75.80, 75.75, that's where you want to stop out around, because it could dip heavy back down to 73 after that. So that's Starbucks. It's still on the macro trend. It's in a downtrend, but it's creating an inside bar on the monthly. This monthly bar could become a 2-up candlestick. So for my stream, huh? Yeah, I was gonna say it's still early, but they just crossing up on the weekly chart. They're crossing into positive momentum on the weekly MACD. So we got momentum indicator right here. So we see we're crossing over to the green, showing we starting to catch some support and strength. It's been catching support for like the last 2 weeks before this, but it put in a 2 down candlestick this past week, but it caught that bounce at the very end of the week.
Bro, Starbucks is going to be alright. They're going to be selling marijuana drinks in the next 10, 20 years.
Oh yeah, I can see that. Little CBD coffees and teas from Starbucks.
Right. Oh yeah.
Oh yeah. They're not letting that industry get by without them getting some. Alright, let's check out the SMH, because semiconductors are on a little decline, but set to rebound. Let's see where we could catch this rebound at. Damn, we had a great chance to catch SMH at 204, bro. It actually went to 200. Damn. That's probably when NVDA dropped down to like $93 real quick. The whole SMH was down. That was the time to jump in. But another opportunity is going to come, I feel it. So let's pull up this monthly. Alright. Last time I was heavily trading the SMH, it was in the 160s. That's the last levels I had. Alright, we're going to say on a monthly scale, this 282 level is going to be a ultimate stop or entry for puts. We're going to check out a few different indicators today and show the people about a few different indicators and how to use them. Man, that was my microphone so far. Alright, call entry on the monthly level for the SMH. We could start jumping in the calls when we get above 231. Let's stretch this out. Stretch it out. 231 is going to be call entry. This is the position I'm going to be looking for. This is going to be the one that pays heavy in the next coming 2-3 years, holding a position on this. That's why when I get this, I'm looking for a long out call. I'm getting this. I'm looking for a call that's like 6 months out. And SMH, I gotta see what their premiums look like on those contracts. Let's look at the SMH contracts real quick, because their premiums could be a little expensive. ETF premiums tend to be expensive. When you can start going far out, like you go ahead, look at some far out look at some far out contracts on SPY. SPY contracts like a year out are expensive as shit.
Yeah, sure.
Cause it's almost like guaranteed money. Like if this how the SPY moves, if you time your entry properly on the pullback, SPY long contracts probably like insurance contracts.
I'll get into a SPY contract if we pull back below 500.
If we get below 500, get a long SPY contract, you know you're gonna be good. Yeah, I'm sorry. Let's put up SPY. I want the SMH. Let's pull up the SMH. Alright, let's see. Still saying SPY. What the fuck? Later, I don't want to update. Alright, so I will try to look like almost 6 months out. Probably a little bit less. Let me see how much these contracts are going for. Okay. We at 224 now. The high was at 280, so I would look for some contracts right around near the all-time high. The 280 contracts are 570, 6 months out. It's not too bad, man. That's not too bad for the SMH. Okay, I like what I see there. So let's chart this out. I like that a lot. Alright. So first take profit on a monthly level. Well, I'm going to say this is going to be dollar cost average in, because I'm going to try to hold this all the way to 280. So we'll dollar cost average in. We close above 230, 239.25. That's the level the dollar cost average in at. And then we'll enter again some more at 250. Then at 250, not dollar cost averaging in anymore. I'll probably do a heavy dollar cost average into my contract there, and then just look to ride it out to 280, and then close out the position up here. Now I got something that look like gold. I don't know. Nah, I'll use that color a lot. All right, we're just gonna make it another. Let's make it dark purple. Yeah, that's take profit right there. I'll put long call target. Yes, I like that a lot, because the SMH is bound to rebound with post-election time. I want to say, that's why I say give it about 6 months, because we got to give this election time to blow and pass over for people to start seeing who's going to be in office, what kind of policies they're going to be putting in place, and then you'll see institutions get a little more comfortable with their money based on where they're going to put it once they know who's going to be determining or pushing these policies ahead for the next 4 years. So if you saw Warren Buffett sat out for the next 3 months, he took a lot of his money out of the market, out of his large positions, and went into cash. And then he took that cash and he bought treasury bonds. He now owns more treasury bonds than the Federal Reserve. So he is going to, oh, my battery's running low. He used those, and it was important to know that he used those on short-term bonds. It wasn't like 10-year bonds he was buying, so it's not too grim of an outlook. He's just getting these short-term 3-month bonds, park his money somewhere. In the meantime, that's going to gain interest, have zero risk of loss. And let me put my laptop and sit out this storm. Alright, there you go. Charge is plugged in. So he's gonna sit out the storm. You could choose to do the same. Stay liquid until post-election. But if you're not gonna stay liquid until post-election, then you want to take advantage of grabbing these dips that are happening during this time. Having your levels where you know you're going to stop out if the storm gets too hectic. But if you're not on the sideline, this is what you should be doing. Proper preparation prevents poor performance. I know y'all heard that before. All right, so we got to take profit. Now we're going to determine the stop, which is just as important as the take profit, if not more important. Because risk tolerance, risk management is key. And your risk tolerance, you got to know your risk tolerance as well to even know what you should be or shouldn't be trading. Because some things you just shouldn't even touch if you don't have risk tolerance. High risk tolerance. I believe options is one of those things. You should be careful if you don't have high risk tolerance. You can't stomach 20 to 30% losses. All right, so look how short that first stop sign comes in. So the stop signal comes in off of the wick, the first monthly wick I can identify after my entry. So my entry wick was right here. That's why I determined I would enter if we close above 231.11. So now I'm going to look and say, what is the first monthly wick that we hit once I come down off this level? Sometimes it could be far away. Sometimes it could be close. This one happens to be close. This one lets you know that don't fuck around with this level because it is a monthly level. As you see, when we broke it this month, look what happened. We came all the way down to 200. So I'm not going to mess around with that level myself. I'm going to say this is going to be my stop out. If I enter this position here, it's going to be a short stop here. And then we can always look for re-entry when we get back above and secure, I say, a daily close above this level, 231.11. I may enter based off of momentum. I may enter in a day where it closes above it on the hourly. But if you're looking on a macro scale, look for it to close above here on the daily level first before you enter this position. But to stop out, yeah, you get in at 231. Yeah, you expected to hold this position. You got a 6 months contract. You're ready to ride it out. You know, you did all this research and leveling and charting, and then boom, let's say we enter, and a week later it hits a stop, or the day later it hits a stop. Stop out. Take the loss. Cut it. Cut it right there. It may only seem like a small loss, but that's the whole point. It's supposed to be a small loss. And you want to cut it there because you don't want to mess with this resistance level, this support level breaking again. It happens quick sometimes. Sometimes it never happens and you never hit your stop, and you could trail it up and it never hits and you could keep taking profit or keep letting your contract grow for you or your position. But when it hits that stop,
This is SMH, right?
yeah, take that stop.
Right.
Yeah, this is SMH. So I was going to look at SMH. I wanted to look at it on the macro scale monthly. So I got my entry and I got my exit. Now I'm going to determine a put entry because if we break down again, I might want to take advantage of the put and ride it out to the downside.
Right.
So let me see.
As far as the spot, what's the macro view on it this week? Is it upward or downward?
On SPY?
Yeah.
SPY was in a weakness on the weekly. Yeah, it's on its third candlestick of weekly weakness. Support level for SPY is around, on a weekly chart, you can see it at 494. We crashed all the way down to like 504 already this past week. So it got close to that support. So it's making like a higher low, essentially.
It didn't go below 5 at all, though, right?
No, it didn't go below 500.
You didn't much weight below 5?
No, the lowest it got was actually 510.
Okay.
Yeah, 510, like it was the low. of the week.
If it wicks below 5 at any point this week, I'm gonna take a short put, but within this month, probably the end of this month, beginning of next month, if it wicks below 5 at any point.
Okay.
You know, 'cause that's a strong level.
The 500 level, let's see. We got above that level back in, I want to say, February. We got above there. We dipped below it in April. So we've been holding it pretty strong since the end of April. 500. It hasn't been tested since the end of April. So this will be the first retest of that level after its breakout. Yeah, I see it holding the support. I don't really see it breaking. If it breaks down any further, then we're looking at a market crash. So if you're going to say if you're going to get puts, if it gets below 500, that means you're anticipating that we're going into recession. And that's what I was going to look at with SPY. I was going to look at the previous crashes on SPY and see how far it tends to dip during these correction periods before it rebounds. The deepest ones I see, the deepest correction was 2008. That thing dropped like 50%, 40%. But most correction, that was like a anomaly event. So if we have an event like that happen again, of course something like that can happen. But the average correction I charted out or measured out is showing around 15 to 20% on a heavy correction. And we've corrected 10% already. Let me see something. Yeah, that was COVID though. So we had that COVID crash. Then our most recent correction on SPY, December 2021 to November 2022. That was around 25%. Then we had a mini pullback right here, 10%, before we took off again. So this is looking a little bit similar to our more recent correction that we had, as far as how the pattern looks like to be shaping out. But let me see something. Because from our high to down here, I think we've been about 10%, right? Or 9%, yeah, 9%. Yeah, this is looking like that correction we did last year in the summertime when we did that dip from, we were what, 450 then? We came all the way down to like 409, and then the market bounced back up. Because I remember thinking like, damn, are we going to go back into the 300s again on SPY? I remember that. And it never went back down. It caught itself. So I wonder what the 200-day moving average was then. I wonder, was it actually in that same space, or was it lower? But let me go back to SMH real quick. Put entry on SMH. If we were going to grab puts, I would look to enter a put right around, if we get back below 213.26. That's a put entry level right there. Who just joined the Discord? Who just joined in? Better not be a spammer. I'll kick your ass out so fast, boy. Spammers love joining the Discord. But alright. 213.26 entry. Pull back down. We'll ride that out to the 200. That's actually a good first take profit level on that. We're going to call this the monthly put entry. Monthly put entry. Gonna make that thing red, low frequency, low vibration color. You know, it's crazy. Red is my favorite color. Then I just found out it's like a low vibration color. Made me feel some type of way. On the scale of color, I think red is like on the bottom of the scale. And purple is on the top of the scale. As far as frequency and vibration that they produce. Alright, first take profit level on the put is that monthly level right there. But if we break down below that, we will definitely exit by 195.98. Get the hell out of there and get out that put right there and take profit. Alright, now let's back out a little bit and look at the SMH on a macro scale. Let's go back. How far we want to go back? Let's go back to, let's say 2019. Let's stretch it out. Let me go back to 2019. Alright, this was major correction here. Beginning of 2022, the SMH went through a major correction. Oh shit, what the hell? Stop playing with me. 47% pullback. That is wild. Okay. That was from January 3rd. That was pretty much all of 2022. Then we had another micro pullback here, 14%. And where are we at right now off of this pullback? How far have we come back? From the top to the bottom. 29%. That's a healthy pullback. 30%, that's a healthy pullback. That is a pretty healthy pullback for that sector. I anticipate the bounce back coming strong. But if we're going to have to wait 3 more months, because we're going to say November, post-November, we'll start to see the change in the market. December may chop around a little bit. Everybody makes their adjustments to whoever's been put in office. And then January of next year is when we're going to start seeing the real movement of the sector or industry, or where the market is going to really be going under this new administration, which I anticipate to be continuing upward as long as we don't have any major global catastrophes, events, or wars like that. That could always change anything, but as things stand right now, I think by January, this time frame here, so we'll say we're right here. From January, by the time we get to January or February of 2025, I could see the SMH at around cracking that 300 level. So that's a 34% increase from where we are now. I like that. I like that a lot. Mind you, where's our stop? How short is our stop? Let's pull the levels back up. We will be taking profit. Ultimate take profit level for us is 24% increase from where it is right now. Our stop loss, just so you can see how tight the stop is running. It runs in this green line. Oh, I gotta spread this out some more. I can't even fit it in there. Pause. All right. One 1.5%. So, see, tight stop, long take profit range. And as we go up in price, as we clear some of our take profit or dollar cost averaging price levels, this stop has to come up with it. This stop doesn't stay down here the whole time you hold the contract. Because what's going to happen is, over the time of the contract, especially if it's a contract. Let's say you got a contract that expires 2-3 months out. What's going to happen is you're going to keep getting hit with theta day over day over day over day. And as you get closer to expiration, the theta gets bigger and it gets more impactful on your contract. So the less price movement you have, if you're not going up and we're not getting closer and closer to this take profit, if it starts staggering around in here for too long and that theta starts impacting you too heavily, then you're going to have to get out, because yes, we may have cleared this take profit level right here. I mean, we may dollar cost average in at this level right here, and between this level and this level it starts floating around. But our stop loss is now going to be moved up to where we entered with our dollar cost average in position. So if we close any kind of daily candlestick below that level, that's where we have to exit. And we're going to trail it up. As long as we keep clearing our levels, we're going to trail up the stop to the next most obvious point of support. So if we clear this take profit, this dollar cost averaging zone right here, our stop loss would have to be shifted up to, I would probably shift the stop loss up to this wick right here on the top of this candlestick. And I will stop out at 246. We clear 250, stop loss moves up to 246. You can't keep it at 228 because your contract will lose way too much value if it pulls all the way back down there after 2 or 3 months have passed of you holding a 6-month contract. Can't do it. So the trailing up your stop is a crucial point of options trading and securing profits. That's what a lot of people don't do. They don't trail their stops up, and a lot of people typically don't dollar cost average into their winning positions. So those are two things that require high level of discipline and planning in advance, like setting your levels up to execute. Because if you're just trading, one, you don't ever want to trade blind. So I'm not even going to say if you're trading blind with no levels. But if you're trading without any trailing stop and you start clearing take profit levels and you're getting excited, all right, we cleared this level pretty fast, and you're holding your contract looking for this one to clear, right? And we're going to dollar cost averaging at this level. If you are not monitoring that theta and that volatility in the market, and we crack below this level, and you didn't have that set as a stop for when we got up to this 250, if you didn't have that 247, 246 as a stop, now in your mind, your psychology is going to tell you, well, our original stop was down here, and I already cleared my first take profit zone over here, so as long as I hold above my entry, my contract should be in good shape. But you may be up 30% right here on your contract. Your stop loss at that point will have you down probably 89, 80, 70, 80%. Versus when we entered right here, that stop loss would have only had you down, I don't know, let's say 10 to 15% in your contract, maybe. So it's a big difference. So that's why you got to trail that stop up. It is very, very important to do. Now, the dollar cost averaging in at the higher price levels, that's also another strategy that people don't tend to do, because they're you could look to either take profit at these levels, or people want a dollar cost average into their positions where they really should be stopping out at. So the initial instinct is when I hit my take profit, which my take profit will be up here. When I hit my take profit, you're in euphoria. You want to see how much further it could run instead of being strict and strong and taking your profit right at that level. But meanwhile, with the stop loss, you'll hold that same discipline. You'll do the same thing. You'll say, okay, you know what? It hit my stop loss. Oh, you don't even have a stop loss level. Oh, it's dipping down. You know what? I'm going to wait for that support to kick in. I'll wait for that support to kick in. It's all the way down to 200 now. Your contract's down 90%. Now you're at the point of, well, my contract is already 90% down. I might as well just hold it and see if I could get a recovery bounce. Bad way to trade. Terrible way to trade. Instead, if you dollar cost average in as your contract is going into strength and you're trailing your stop up, that's why I said the discipline in doing that is necessary, because you can't dollar cost average in at a higher price and keep your stop the same, because you're going to take even a larger loss at that point because you put more money in at a higher price. So you really have to become disciplined with your stop once you dollar cost average into your winning position. So my stops are going to become tighter and tighter the more I dollar cost average into a position, because I don't want to take the risk of my winning position now becoming a losing position with more money in it and giving me a heavier loss than I would have initially taken on that first entry. Because first entry, I'm not going to go that heavy on this contract. So we saw the SMH contracts are like $500. I'm not going to try to get 3-4 contracts right here. No, I'll probably get one contract right here, right? And then it gets up here, maybe the contracts become $700 right here, right? So you know what? $500 is initial investment. So now I might try to push to get 2 contracts right here. And so that's $1,400 now I'm putting in versus $500. As we get up here, now the contract may be worth $1,000 a contract, right? Or maybe it's worth $1,500 for one contract, or $2,000.
Mike, I'm gonna have to get off my phone on 1%. I'm not at the crib.
All right, bro. Holla at me, man.
Yeah, I'm on the road right now. I'm about to leave here now.
All right, man. Holla at me. If you going back to the spot today, or are you gonna be out?
Nah, not today.
All right, bet.
Tomorrow afternoon.
All right, bet. Holla at me. Yep. So we get up to this level right here. What we're gonna do? Let's say the contract is now worth $2,000, right? You could decide to take profit, but that's not the level I'm looking for. So for me, I'm gonna hold until my take profit level, just like you should hold until your stop loss level. Don't get shaken out until you hit your stop loss. Don't get shaken out of a position until you clear your take profit. If you did the analysis properly, this level should come to you. So I would dollar cost average in, maybe get one contract here. So I spent $1,400. I spent $500 on the first contract, $1,400 on the second contract entry, and then I'm gonna put $2,000 in on the third contract entry. But after that, I'm shut out because I'm not looking at any more levels up here where I could possibly dollar cost average in. And the next level that comes up after that, I'm looking for take profit. And I usually don't do the dollar cost average in on more than 2 levels past my entry. The third time it hits a level for me, I usually take profit there because what goes up must come down. So I don't try to overextend myself into take profit levels. Now, if we get up here and I take profit and the market keeps pushing and showing strength, what I'll do is I'll wait for that strength to have a little pullback, and maybe this is the new support where I took profit at. Maybe that's the new entry for the next position because it pushed up way past it and now it pulls back down, and this is now support instead of resistance. So now I'll re-enter my calls here. That's where you got to have patience. So that's the third element. So you have discipline and patience. Those are the 2 most crucial things to have whenever trading. On small accounts, big accounts, doesn't matter. If you can't manage these traits on small amounts of money, just because you put in $10,000 is not going to make you all of a sudden this responsible investor or trader, because you never mastered, or you never even took the time to show yourself that you produce evidence that you're mastering the skill of discipline or entry and exit timing or stopping your losses. Until you could show yourself you're able to do that with small amounts of money or stay in an investment long term without having to jump from company to company to company. Until you show yourself you could do that, then I don't think you should be entering the stock market as far as trading too heavily. You should start very, very light, very small amounts of money, and start mastering the disciplines before you start trying to make large cash outs. All right, that's the SMH. I was going to look at SPY, but we touched on SPY a little bit earlier already with my boy G and how we had these pullbacks, and we're in the middle of a 10% pullback right now. We caught support. It could potentially, let's see, how far of a pullback would that be if we came down to this 480 level from the top? If we came down from the top down to about right here, that'll be about 15% pullback, which is still possible. That can happen. So we can come down to around 477 in this pullback that we're having between now and the election. That's a possibility. So let's look at for some potential entries on a put on this pullback, because we got a support bounce, which is nice, because if we are going to pull back, this is giving us a chance to catch that pullback, instead of chasing it. Yeah, SPY got a lot of levels in on SPY, so bear with me. You know what we'll do? I'll pull it up on, a lot of people trade SPX, right? Same difference, same thing. So let's pull up the SPX. We're going to say on the monthly level, if we get a pullback to, yeah, we'll enter puts on SPY if we get back below. We're actually at a level right now, like a perfect level. If we start closing back below 530, I think that's a sign where you could enter puts below 530, but then you got to have a short take profit. If you want a longer take profit range, you want to enter that put at around 525 on SPY, or $5,266 on SPX. Yeah, right around there. So this will be our monthly put entry level. Listen, I don't hide no information, no gatekeeping of knowledge. If you come to my sessions, you come to my Discord, I'm going to teach you what I know. What I know, you're going to know. I don't try to hide anything. I do these free charting sessions every Sunday to give you guys a glimpse into what I provide for my community and my members, because education is key when it comes to this trading lifestyle or an investing lifestyle. You got to be educated on what you're doing, and you also have to understand that it's not just charts and numbers. It also has a lot to do with you personally and your personal habits and the way you are with certain things. So the market exposes a lot of that, and a lot of what I try to talk to my group about is mastering those disciplines by doing things, by constantly being prepared, setting your levels, having routines that you do when you trade. These kind of things will ingrain you into a behavior that is good for you when it comes to investing and trading, versus these bad habits that, yeah, you may have a good day here and there, but your bad habits are always going to creep up on you and create that downfall that crushes your account. And you're up 100% on the year, 120%. You've been killing it with option trading, and you go extra hard on a position. You don't have your discipline of stop losses in, and all these kind of things that I talk about, and your account gets crushed. And in one trade, it can happen. In one trade, I've seen it happen to people countless times. Building up an account all year, and then they get too aggressive into a particular trade, something that they were so sure on, and don't have an insurance position on it as far as a counter position that's a hedge, and they don't have any stop loss position in, the account gets blown. Easily. Because these kind of things happen. I'm sure somebody thought the market was just going to keep on rallying on when we broke out from here. We was going to break out. Oh, yeah, we're going to get to 600 or 6,000 on SPX. And you had a vicious reversal done to you. So if you started going extra heavy in your position right here, once we cleared this wick, and you didn't have a stop out right here, this whole pullback would have crushed you right there. And then you're at this point now of no return, of where I got to hold because I'm down so much in my position. Don't put yourself in that position. All right, so back to SPX. We are going to say monthly put entry is right at 530 on SPY. Let's say that'll be like around 530 on SPY. And we're going to look for take profit. Our first take profit or dollar cost average end level could then be at the bottom of this wick right here. I will honestly probably take profit right here instead of dollar cost averaging into my position, because the take profit level is so close after that. If you look right here, remember we're doing this off of the wicks, so if you look right here, that next wick down, so you're talking about taking profit at 50, let's say that's 508 versus 505 on your position. If you're in a long position and you really got in at the entry level up here at 525, you're going to be up more than enough, and you should be happy with your profits right there. Now, you take profits and you clear out right here. You could look for re-entry if we continue in the downtrend, if you want to try to play it down to this monthly wick, but then I will go down to the weekly levels for that and look for the levels for that, but we're not going to do that today. We're just doing monthly levels, monthly entry, and exit levels, because these are going to be crucial with the pullback we just had to see which direction we're going to break in. The monthly levels provide you that intel. Daily levels to me aren't strong enough. Intraday levels definitely not strong enough. Weekly levels, they could tell you maybe what's going to happen next month. But these monthly levels, they'll let you know. If we start closing above or below these levels, that's a clear signal of where we're going. So that's why I like to use monthlies for entries, for macro positions, because I'm cutting back on intraday trading, period. Doing more monthly contracts that expire 2-3 months out or a year out from now. Combining that with my long-term investment strategy. The short-term options create great wealth building and gains in your account, but the volatility that's there as well is what you're going to have to sit through. So everybody will show you their gains. Very few people are going to show you how many losses they take on those short contracts and how volatile it could really be. And if your risk management isn't top tier as well, the short contracts are even worse for you. So I don't like to teach people about taking short option contracts because I know most people are not coming in with the discipline needed to trade short contracts. I will still take short contracts time to time, but I'm trying to shift my strategy to lead by example, to taking longer contracts and showing that you can still make large amounts of profit in long out option contracts versus trying to time and flip all these weekly contracts. And also for tax reasons as well. So the more money we start making in these option trades, the more money you're going to have to pay in taxes to Uncle Sam. And in order to minimize that in a way, sometimes people with large amounts of money or investments in option contracts or money to invest in option contracts, they'll buy contracts multiple years out. So they'll get contracts. You could get contracts on SPY. Let me see how far out SPY contracts go. Let's just look at the SMH real quick. So for the SMH itself, you could go all the way to 2026, December of 2026. So that's 2 years out. So these contracts cost, if you're doing anything near the money, you're looking at $5,000 a contract, you know? So $1,200 for the cheap contract, $1,000 for the cheapest contract. But it expires all the way in 2026. You know, if you're optimistic and you understand how market flows tend to work and how the market is on a consistent upswing, 2 years gives you a lot of time to sit through a couple different market cycles before you can time your exit. So you don't have to hold for 2 years just because you got a 2-year contract. But the 2 years, what it does is gives you time to sit through different cycles in the market and either dollar cost average in on those peak cycles and then exit at the top where you feel the top is, or to be able to sit through the down cycles. And these are contracts now. These long contracts, these are things that I am an advocate for dollar cost averaging on your pullbacks on. So when you have a pullback in a long contract, you want to have certain levels where your dollar cost average in on the pullback. Let's say you're taking a loss, because these contracts are things that you want to hold for long periods of time. If these are short contracts, I don't advise dollar cost averaging in on pullbacks often at all. But if it's a long out contract, a year or more out, that's when you can start dollar cost averaging in on pullbacks, because you may just be getting caught in a cycle. You could enter a contract, maybe you entered in at not the perfect time, and then you get caught in a little pullback like what we just had. You could have a dollar cost average level in on a pullback. I have $2 cost average in levels on a pullback. If you hit that third level, that's my stop. Just like the third level on the way up is to take profits, the third level on the way down is a stop. So you got to look at it and say, all right, let's say SMH pulls back 200. All right, that'll be my first dollar cost averaging level on my long put. And then it pulls back, let's say again, let's say we have a pullback again. Oh, shit, what did I just do? That level always there like that? All right. Let's say we have a pullback again to this wick right here at so SPY, let's say, okay, we enter a SPY call. Let's say we were in a long contract on SPY right here, and we caught it right here at 50, at $530. We entered a long call. If we pull back on that long call to from 530 on SPY to 5100, or let's say 510 on SPY, right? We'll say that could be dollar cost average in area 1 because our contract expires in 2 years. So we may get caught in a pullback cycle. Then you have dollar cost average in area number 2 around $500 or 5,000 on SPX, right? Now, if we pull back below and we start closing below level number 3, which is pretty much 495, or I would say 490 on a SPY, that's is where I would stop out that long position. So you're playing the support and you're looking at it and saying, all right, we pulling back. All right, we got down to this level. And only time I would say dollar cost average in at these levels is not if it's a clear sign that it's clearly tanking through the level. Obviously not. You want a dollar cost average in at these levels if you see, all right, pull back to that level and you see how we're starting to, we show support here. And you see that high wick, it bounced. So on a daily chart, it will look something like this, right? And I would say, okay, we pull back down to my dollar cost average in price and we show support and we're bouncing. You know what? Let me get some more before we get back to my entry. So let me grab some more somewhere around here in this price range between 510 and 515, you know, and then add to my position right there with another contract. Now, if we pull back again and we break below dollar cost average in area number 1, all right, we ready dollar cost average in off of that level. We thought it was going to bounce. It didn't, and it actually broke back down below it. Now we're going to say if we get below 500 or we get to 500, that's where we're going to look the dollar cost averaging in. That's where we're going to look for support to come in. As soon as we see support coming in at 500, we're going to add to our position and count on that support holding and the rebound coming in. But if that's not the case and we see support coming in and it starts to show support, we dollar cost averaging and rejects, 495. Get out of there. We're done. We're stopping out at that point. Because it's a long contract, and at that point, you will probably have taken at least a 30% loss on your position. And you want to go. You don't want to take heavier losses than 25, 30%, even on your long contracts. You know, because like I said, you're going to be dollar cost averaging in. If you just held your original position and never dollar cost average in, your loss percentage will be higher by the time you got down here, of course. But the dollar cost averaging in is part of the strategy. So once you get to your second dollar cost average in, if that contract at that point goes down 30%, then cut it. You gotta cut it. All right, and I think that's all I want to go over today. That was a decent little charting session. We did some SMH, we did StarBucks, and then we looked over SPY. We looked over SPY pullbacks and corrections and where we are right now in the correction cycle. We could probably go down another 5%, like I said, so I could see, you know, that 495 level coming in. So I'm gonna watch and look to see if we get right around this area 500. I'm gonna be interested in long calls for sure. 495, definitely gonna enter a long call there, and then I'll just chart my positions of dollar cost averaging in, like I just said, and the stop loss from there. But 495, we get down there, I'm going to be very confident we're going to bounce from that area. So I'll be entering long calls. Look for some year out or 2 year out contracts expiring in 2026. And what helps out with those is, like I was saying earlier, it's good for your tax situation, because once you hold a position for longer than a year, your capital gains tax is cut in half. So you go from having to pay like high 20% in taxes on your capital gains to like 15% tax. So that's a major benefit in itself, especially once you start making large money. You don't want to have to be giving it all away in taxes. That's probably one of the biggest headaches of people who are in higher categories of wealth. They're always concerned with tax policies and taxes, because that's where you usually get hit the hardest if you're not aware of different strategies and ways you could get around it, or things you got to do in order to get tax incentives. But that's one of those methods that comes to mind when investing, that you got to have contracts and investments that you hold longer than a year to avoid certain tax penalties or tax costs. You don't want to make $50,000. You don't want to make $100,000 in a year, and then have to give $30,000 away to Uncle Sam because you took it out a week too early. You closed your positions in December instead of waiting until January, and now you got to give him $30,000 instead of $15,000. Is that much of a difference a year could make? So you could just imagine that on a broader scale when you're talking about millions of dollars now. Why? So that's why people who are in higher net worth categories usually take further out positions. Yes, it's because they can afford it, but it's also a smarter move for multiple reasons outside of the data that you get, the time insurance you're getting on the contract, and then you have the tax incentive behind it, and then you have the ability to convert it into or take advantage of the cycles that are coming. You could take advantage of dip cycles where other people will have to get stopped out their contracts on dips because their contract expires too soon. So there's a lot of benefits to buying further out contracts, and you just have to increase your discipline and risk management, which I think you should be focusing on irregardless of what kind of contracts you enter, or if you're not trading contracts at all. Even if you're investing, you got to have a certain strategy and discipline you stick to. All right, everybody, appreciate everybody who came through, joined the stream. Hope y'all learned something today. I'll be back next Sunday. Join the Discord. It's in the Twitter. If you're on Twitter, it's in my profile. If you're on YouTube, it's in my profile as well. Join the community. That's where you're going to get all the price levels, exclusive trade call-outs, and personal guidance from me. All right, everybody. I'll see y'all next week, Sunday, 6 p.m. Put it on your calendars.